What if I told you the United States is trying to convince China, the world's biggest oil importer, to give up its cheapest and most reliable energy supply in favor of something more expensive? And what if I told you Beijing's answer was not only a firm no, but a reminder that Washington has no say in the matter? This isn't just a diplomatic spat. It's a collision of energy politics, global trade, and financial brinkmanship, and the outcome could reshape the balance of power in the world's economy. The push against Russian oil. Donald Trump is pressing China to stop buying discounted Russian crude and instead purchase higher-priced American barrels. It's an audacious move, coming from the same Trump who once rallied crowds with drill, baby, drill, urging U.S. producers to pump at full speed. But producing oil is only half the battle. The other half, finding buyers. Instead of securing new markets in smaller, more willing countries, Washington has aimed at the largest one on the planet, demanding that China abandon low-cost Russian supply in favor of U.S. exports. Beijing's reply was blunt: no deal. The reasoning is straightforward. In 2024, Chinese refiners imported around 108.5 million tons of Russian crude, about 2.17 million barrels a day. That's not a side deal. It's the backbone of Russia's energy sales, with China taking roughly a quarter of all Russian oil. Exports. From Beijing's perspective, Russian oil is dependable, cheap, and politically aligned. Asking them to walk away from that in exchange for costlier American crude isn't a business proposal. It's a non-starter. Why U.S. oil can't compete on paper? Trump's energy policy delivered results. U.S. crude output surged, hitting near-record forecasts for 2025, 13.4 to 13.6 million barrels per day, driven by shale production and strong flows from the Permian Basin. But record production doesn't guarantee record sales. Here's why. Price. Russian Urals crude often trades $10 per barrel below Brent, making it hard for U.S. oil to compete. Once you add shipping, insurance, and logistics, the American product gets even pricier. Geography. Russia's pipelines and shorter shipping routes make delivery to Asia faster and cheaper. Refinery compatibility. Many Chinese refineries, from state-run giants to smaller teapot plants, are configured for heavier, sour grades like Urals. Switching to lighter, more expensive used crude would require costly modifications and reduce yields. Even if China wanted to pivot, the economics are brutal. Russian barrels don't just arrive cheaper, they also bypass Western restrictions through secure pipelines and a dedicated shadow fleet of tankers. Transactions are often settled in yuan or routed outside the dollar system, insulating the trade from U.S. financial pressure, the limits of U.S. leverage. Washington's strategy seemed to rest on an outdated assumption that a few stern statements and tariff threats would make Beijing fold. That might have worked 20 years ago, but in 2025, China isn't taking orders on something so critical to its economy. Publicly, Chinese officials called the purchases a sovereign choice and warned against politicizing normal trade. Privately, they reinforced their commitment to Moscow. Every time the U.S. criticizes the deal, it only hardens Beijing's resolve. The trade war spillover. This oil dispute is happening alongside an already tense U.S.-China trade war. Earlier in the year, Washington sharply raised tariffs in some cases hitting triple-digit rates, aiming to force Beijing to change its trade practices. At first, Chinese exports slowed, but the recovery was swift. By mid-year 2025, GDP growth 5.3% in the first half, beating expectations. Industrial output up 6.4%. Manufacturing up 7.0%. High-tech manufacturing up 9.5%. Exports July up 7.2% year-on-year, far above Forecasts. China also posted a record trade surplus of $686 billion in the first half, a 34% jump from 2024. How? Beijing targeted its retaliation. It hit politically sensitive U.S. sectors with tariffs, doubled down on trade with Asia, Africa, Latin America, and Russia, and rolled out domestic support for exporters. Export credits, inventory management, pricing adjustments, all designed to keep production stable. The result? Washington's high tariff strategy failed to break Chinese manufacturing dominance. Instead, it raised costs for U.S. businesses and consumers, creating political headaches at home. The helpful proposal that wasn't with tariffs falling short. U.S. Treasury Secretary Scott Bessent tried a softer pitch. He suggested China scale back manufacturing, framing it as a way to rebalance its economy. On paper, it sounded like friendly economic advice. In reality, it was a calculated attempt to shrink China's production capacity and give U.S. manufacturers a chance to catch up. But here's the problem. China currently produces about 30% of all manufactured goods in the world. It's industrial. Zones cluster thousands of suppliers within the same region. A component can be designed, built, tested, and redesigned in days. The U.S., by contrast, has suppliers scattered across states with longer timelines and higher costs. Even if China stopped its factories tomorrow, no other country could replace its output overnight. Building that capacity would require massive investment, industrial-scale city planning, a trained workforce, and a web of interconnected suppliers. That kind of transformation takes decades, not months. The debt clock ticking in Washington, meanwhile. The U.S. is preparing to raise $100 billion through short-term Treasury bills, an unusually large injection of debt into the market. The plan depends on strong investor appetite, but each auction adds pressure on interest rates and raises questions about how long America can sustain this borrowing pace without serious consequences. Foreign investors, including China, still play a major role in U.S. debt markets. That creates a strange dynamic. Even as Washington confronts Beijing on oil and trade, it still relies on Chinese demand for treasuries to help fund its government. The Putin factor. All of this sets the stage for Donald Trump's upcoming meeting with Vladimir Putin. If the White House wants to ease economic pressure quickly, calming global oil markets is one of the fastest routes. A resolution with Moscow could help bring prices down, giving Trump a much-needed domestic economic win. But any breakthrough will come with trade-offs. Russia's oil discounts to China and India are not just a business arrangement. They are a pillar of Moscow's wartime economy. Convincing Putin to limit those sales would mean offering something substantial in return, and that something could reshape global alliances, where this could lead the pressure campaign against Chinese imports of Russian oil was never going to succeed. It underestimated Beijing's economic priorities, overestimated U.S. leverage, and ignored the geographic, logistical, and political advantages Moscow enjoys. At the same time, Washington's wider tariff strategy has backfired, strengthening China's manufacturing base rather than weakening it. The suggestion that Beijing voluntarily slow its industrial output is, frankly, unrealistic. And with U.S. debt issuance at historic levels, the Treasury's room to maneuver is shrinking. The bigger picture is this: energy politics are colliding. With global trade strategy, U.S. influence over China's economic choices is weaker than many in Washington realize. And without a major shift, either in oil market dynamics or in the U.S. approach to trade, the standoff will drag on. The coming months will be defined by two parallel negotiations: Washington's quiet talks with Beijing over trade and manufacturing, Trump's high-stakes meeting with Putin over oil and energy stability. If either of those breaks in Washington's favor, the U.S. could regain some leverage. If both fail, America may find itself producing more oil than ever, but struggling to find buyers while its biggest economic rival grows stronger. This isn't just about barrels of oil or tariff rates. It's about whether the U.S. can still bend the world's second largest economy to its will, or whether 2025 marks the year that leverage finally slipped away.